Hi, thanks for tuning in to our Practical Nerds weekly podcast. I'm Shubh, and together with my partner and co host Patrick, we normally invest in founders in design, construction, renovation, and logistics technology. Many of our friends in the ecosystem wanted us to start a podcast on the built world, and in return, we decided to honor their request with a show about nothing at all.
Hey Patrick, we're back again, man. How you been?
Doing great. How about you?
Can't complain now. I think things were not so good at my end a little while ago, and
Oh,
maybe a peek behind the curtain. So we were actually supposed to record this episode a few days earlier, um, and a lot happened in the world that day. The least of which was that I was down with a flu, which is why we had to move this recording. But many other things happened as well, right? Most notably, the IT outage caused by an event with CrowdStrike, right? And obviously that was in the news. If for some reason you aren't aware, I'm sure a little bit of searching will get you quickly up to speed. And I think that set us up very nicely for something that we could perhaps discuss today.
yeah. So, what we're discussing today is all the events that can happen to you in construction tech, mostly as a founder, also as a shareholder, you might be affected by such events. And we're going to talk about mostly what to expect from
Hmm.
such events. A little bit we'll talk about how to deal with it, but every situation is unique. So, we thought let's rather spend more time on bringing more clarity and is expectability, is that a term, more
Yeah, let's roll.
predictability,
Mhm.
yeah, into, hey, if such an event happens to me, what should I expect of it?
Hmm. I think the first thing to mention before we get into some of these events is if you know what you're doing, you'll probably put yourself in a zone where you probably never have to deal with any of these events if you know what you're doing and you plan ahead, run a tight ship, which is actually, frankly, I would say is the advice. If you have to take one advice away, plan your firm or your journey in a way where you actually reduce the probability of these events down to zero as much as you can, or even eliminate them if it's in your control. And I think that is what I would advise first up before we go into specific examples. So the takeaway should not be like, hey, if you're in this tight situation, do this, and now the problem is solved. The real solution is you should never try to get yourself in that tight situation in the first place.
You said the operative word: stay in control.
Hmm.
Stay in control. The number one thing you do not want to do is give a large portion or a high concentration of your IT base
Hmm.
to a single cybersecurity vendor that has access to your kernel. That certainly was now the learning from that, and that had to do with giving away control. So
Hmm.
stay in control. Shub, what is the first event we want to talk about where I'm outside of my control and something bad happens to me as a founder in AECS, architecture, engineering, construction, and supply
Yeah.
chains?
I think the first thing perhaps we can talk about, which we're seeing more and more of it happen in the last 2 years, I would say, is as a founder, you put together a round and you believe it's come together well, it's happening, with certain lead investor, maybe that's the only investor, maybe it's a group. And you have planned your journey accordingly, assuming the round is happening, you're getting this inflow of cash, and you've planned ahead. But then suddenly out of the blue, for whatever reason, the reasons itself may determine whether it's how much of it was in your control to begin with or not. But for certain set of reasons, the round is no longer happening. The investors have pulled out, right? And now all these plans you made, assuming this cash was coming in, you've got to throw these plans out because the cash is in fact not coming in, right? And I think the first thing to take into account here is with many companies, a lot of times it directly affects the firm's survival in a very imminent sense of the word. As in, if the round is not coming, they may go belly up immediately.
Yeah.
And I think that's the first example of an adverse event that perhaps people listening to this are wondering, hey, what do I do if I find myself in this situation?
And again, we want to make today So I think the event is the event that you're describing is unfortunately more regular than any of us would like. It's not like it happens all the time, but even within our deal flow, which is several thousand companies a year, I would say this happens a couple dozen times that
Yeah.
we observe it. I want to talk about what does it feel like, so that anyone listening and who has had the good fortune of this not yet happening to them, you can be more mentally prepared in case it happens. What will it feel like? And so, Shub, I would say, first of all, let's lead into this type of event. So I'm a startup founder. I put together a roadshow of fundraising. I had good conversations with investors that have serious interest. And in the end, one of them or more of them issued me a so-called term sheet.
Mm-hmm.
I pick one of the term sheets, we sign, they countersign. Term sheets in the end are almost always non-binding, and the ones that are binding, even there are legal challenges to actually enforce the bindingness. So in the end, they're almost always non-binding. So
Yeah.
I've signed this, they've signed this, and now my expectation is that the round is coming together. Now, when it's a very early round in the US, that the time between signing the term sheet and actually getting the money is, we're talking weeks.
Mm-hmm.
When it's a late round and perhaps in a less liquid market or a less normative VC market, this can take months,
Yeah.
right? And so anywhere in between that, you will land depending on your stage and what market you're in, how large the round is, etc. So there is some uncertainty between signing and having cash in the bank. But we all like to believe it's never uncertain because, hey, I met this investor and they really signaled me deep interest and I've referenced them and they have good references. But hey, you don't control what happens to the market. 2020, Q1, COVID, a lot of term sheets exploded.
Mm-hmm.
That happened a lot,
Yes.
a lot. And so you don't control what happens in the market. Now, when that happens, here's how it feels like. So the investor will call you, or actually the coward ones will just write you an email and say, hey, we've reviewed the market. My partners are no longer comfortable with moving forward with the investment. Ha 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 ha. I'll see you in a few months. Prove out the things. Good luck, and see you then. So none of that feels funny. None of that feels like, oh, sure, we'll just talk in a few months again. You will feel betrayed. You will feel like someone gave you a handshake deal and they walked away from it, having basically free optionality from you, because the term sheet mentioned you don't market your company anymore. There's exclusivity.
Yeah.
So the investor that just walked away had free optionality. So almost every founder that I know that happened, whom this happened to, felt betrayed and taken advantage of for that exact reason. So that's like the personal side. The practical side to it is your runway might actually be nearing. You might actually run with this into a liquidity situation where you don't know how to pay your employees, how to pay your suppliers. Hopefully not in days, but in weeks or in a few months, right? So now you're scrambling, having to find alternative sources of capital. But the people that you had in your fundraising process, it's tough to go back to them, because once they hear that the term sheet fell through, they will come to all sorts of questions and conclusions of why that happened. And so their appetite all of a sudden also is not the same that it used to be. And so that's what the situation feels like, is because of someone walking away, because this was outside of your control, depending on how long the closing took. Now you're scrambling to find an alternative way of financing, and it's probably going to be a different one than the one that you actually did fundraising for.
Yeah. Again, I think lots of things to unpack here. I think I would say and ironically, the situation is most controllable or fixable if this is actually your very first round of funding. Because by definition, you had nothing to begin with in any case when you started, and so this should not be more than a minor speed bump, unless, of course, the reason the investors pulled the term sheet is they discovered something flawed about either your character or something you mentioned, etc., and that's the reason they pulled out. In which case, frankly, look into it, I guess. And I mean, I don't know how that can be fixed, but anyway, maybe we move past this for the time being, because what I'm trying to say is, if you are the problem, then maybe you need to fix that part of the problem
Yeah,
first
that also happens.
before pointing fingers at others. Um, if this is not the very first round of funding you're raising, and especially if it's Series A onwards, what at least I like to tell companies I work with is to always plan for 12 months runway at all points of time. And by the way, when I say 12 months runway, I mean net of any working capital needs you may have and things of that sort. For tips on that, please check out our most recent episode on burn, where we go into what that means as well. Um, so in essence, what this means is you go into the market always in a position where you are at, you have at least 12 months of runway or something close to that. So that, let's say if you've been in the process with this investor or investors for say 3 to 4 months, and for whatever reason things fall through, you still at least allow yourself say 6 to 8 months or more, hopefully, of time to course correct, cut expenses, try to put together a different kind of round, etc. And I think definitely what would be a terrible idea, and I have to say this out loud because I've actually seen such examples, people who assume that the round is happening and ramp up expenses accordingly
Oh,
when
yeah.
you kind of have the resources in the bank already. And the unfortunate truth is you don't. And all those additional expenses will come back to bite you fairly
I
soon.
actually remember a deal that we saw in, I want to say 2019, logistics space, Asia.
Mm-hmm.
In the end, so it was not our issue. It was not a portfolio company. We also didn't participate in the deal, but you had friendly relationships with the founder. That's how we got to know of the situation.
Mm-hmm.
Was that actually, and I think you knew one of the existing investors, if I
That's right.
remember correctly.
Mm-hmm.
And so that's how we got to know of the situation, is where they actually did have a term sheet. The term sheet fell through, and in the meantime, they had already done a ton of hiring.
Yes. Yeah, I think, and the reason why that is terrible is on many accounts. I think, and again, this might be going a bit too granular, but just to walk it through here for the founders who are listening to us, if you ramp up expenses prematurely, as in before the money is raised, so quite often founders, the way they justify this is they'll say, hey, you know what, we're getting this new round of capital, we need to deliver growth and we need to maintain momentum, etc. Once the
Mhm.
money comes in, to show growth targets, etc. And therefore we need to get a move on, and so on. Now, the thing is, if the money doesn't come, you'll anyway have to cut down expenses. You'll have to perhaps let go of all the people you have hired in this process. So you'll see actually what appeared like a temporary rise, you'll then see like a very sharp decline. And then you'll have to contend with explaining to people why you had this sudden drop off,
Yeah.
which you may not be able to get back to for a very long time. And I think that's going to be a much, much worse story to explain to people, rather than, hey, why were you not growing fast and why were you not hitting the targets, etc.
So why don't we take this spontaneously as the second type of event?
Mm-hmm.
Uncertain event, unpleasant event, is the hiring of large parts of your organization. Because this is, again, I want to just set the scene here for how this could look like, how this could feel like, right? And I think this is especially important in the context that you are right now describing, Shub, is when you have never laid off 5 people or 10 people, you will not know what it feels like. Having fired one person is not the same.
Mm-hmm.
Having had friendly parting of ways, it is absolutely not the same.
Yeah.
What is very taxing on your mental health for a while, for most people that are not sociopaths,
Mm-hmm.
is having a day of 10, 20, 30 exit discussions.
Mm-hmm.
And then, now to connect it to the previous example that you gave, imagine you hired those people just a week before or a
Yeah.
month before because you prematurely hired them.
Yes.
So there's a whole host of other causes for a situation where you need to fire double-digit people in a day. So we'll get to the causes, or we'll cover them indirectly today. But the event that we're now describing as a second event here is this firing of people. And so most founders would what it would feel like to them is that shareholders tell them, hey, you need to get rid of the staff. We need to get into more of a default alive mode or into a runway extension kind of mode. Very rarely would it be triggered by you making an internal analysis of, oh, I think we're not up to the quality of people. That does happen, but most of the time it is forced onto you. It is more externally triggered by some of the other events. And so then someone will tell you, hey, you actually need to get this under control. Okay, so then you would do an analysis. Most of the times with your founders, if you're a little bit later stage, you would do it with your department heads or your business division heads, and you would say, okay, now actually let me know where do we really earn ROI on our salary cost. And so the pockets where we have high ROI, let's make a cursory look whether there's some fat that we can cut out there. And typically you would want to bleed everywhere and kind of increase the efficiency. But the pockets of your business where you earn high ROI, you wouldn't spend more time on. Now, the pockets where you have low ROI, that's when then all of a sudden you're having discussions among the founder team, division heads, etc., and say, okay, now tell me like who are the two people that we absolutely have to keep and who are high performers and who are not. Which means, by the way, that if you have to fire 30% of your company, it's not a flat 30% typically. Yeah. It's typically 10% in your high ROI pockets and it's 80% in your low ROI pockets. And that's very, very painful to do. Also because you're creating then, like I want to walk you through the day, Shub, right? So most people would lump it into a day when something like that happens in order to minimize the disruptive effect of uncertainty on the employee base. But still, even within a day, it does happen. So how many founders would do it? And I'm not saying whether this is good or bad. I want to leave the judgment out. Most founders would do it where they would actually then call person after person into the office, have 10, 20, 30-minute discussions. And your colleagues, they have eyes.
Yeah.
They see what's happening. They see the marches. They see the faces. So the first meeting, it's okay. The second meeting, okay. The third meeting, people have you figured out what is happening. Yeah. So that is like a death march kind of a day. And it will feel to you as a founder very bad, to the employees even worse, but to even the people that aren't even technically affected, the whole atmosphere is really poor. So that is another big challenge of such a day, is like, okay, how do I then rally my troops again?
So before I respond to this, I want to make a quick detour back to the first event we spoke of, and then I'll come back to talking about the event of letting go of people and resources, etc. One, I think, common other mistake I've seen founders do, and I think that also increases the risk of something bad happening in the event that the investor pulls out, is I've seen founders, so once they decide they want to go with, say, a certain investor, they also kind of decide to not be often on their best behavior with everyone else, assuming that they've locked in this other investor, they're good to go, etc., etc. They see it as a win, right? And they think, the job's done. And which is why I think I wouldn't say it's burning the bridges. It's not as dire as that, but you don't maximize your chance of succeeding if you need to go back to those investors. So that's just a tip I'll share, just in the hopefully low probability event that your round falls through. Now, coming back to this, look, it sucks. I have to say, it really sucks. So in the few examples where I witnessed these kinds of events happen, in my capacity as an investor, it feels very draining on the energy of the company, even if it is for a short time. Make no mistake, it has a very negative effect on everyone, and which is why whenever we have these discussions and I hear founders say things like, okay, we have let go of these many people and now we're all good to go and everyone's feeling great, I always like to stop and think, hey, are you sure? How's everyone else who's remaining? How are they feeling, right? Are they feeling good? Are they feeling motivated and happy? Or are they kind of shell-shocked and, applying for jobs elsewhere?
Right.
Because that's the real problem area. What I like to always suggest to companies, and it's not always possible, I acknowledge that, but if it is possible, is to cut once, but cut deep and be done with it. I think
Fully
what too
agreed.
many founders try to do is they're scared of cutting deep the first time. So they kind of cut a little bit, right? Then a week later, there'll be another cut. So, and this process can go on for like 2, 3 months or more. At that point, everyone is like terrified. They don't know what's happening. They don't know, how long these cuts will keep going. And I think that's a terrible situation to leave, to keep firstly yourself. I think you're not holding yourself accountable, because that also means you're dragging the cost cuts that much longer, and it's taking you that much longer to figure out where the inefficiencies lie in your system. If it I mean, I know it's very terribly inhumane to refer to these to actual people as inefficiencies, but let's say additional cost which you could have optimized. Why should it take you 3 months or more, right? Why can't you be on top of the situation that much quicker? um, I wish more founders would act on that.
Yeah,
Now,
and that is
keeping
exactly the reason why these instances are so important to have empathy for before they happen to you.
Yeah. Keep in mind when I say this, I'm not advocating for, when I say cut deep and cut once, I'm not saying, hey, fire out a mail, or do a 5 minute Zoom call and fire people that way, because there have been cases of that as well, which I'm sure those of us who've seen some of these cases either during the pandemic, or I think it was sometime in 22 or 23, pretty famous instances of some well-funded companies letting go of hundreds of people in like a 5 minute Zoom call. So that's not what I'm saying. I'm saying do like a professional process. Each employee is deserving of their one-on-one time, but please just cut deep ASAP.
Yeah, it's you're talking about the round of cuts, the
Hmm.
numbers of rounds of cuts
Yes.
should be one. I wholeheartedly agree. Um, and so you're describing if you don't do it that way and you then have more than one round of cuts in
Hmm.
a whatever relatively short time frame, you're saying, hey, actually it creates a lot of uncertainty among the remainder of the group that can lead to action paralysis,
Yeah.
etc. What it can also lead to, and that's something that first-time founders oftentimes do not anticipate when they do this kind of mistake that you're describing, is it has this red tail effect where if you think of your organization as a let's say sandwich, right? So you have the bottom 20% of your team, you have the top 20% of your team, and you have the middle 60%
Hmm.
of your team. Now, your round of cuts, if you're doing a proper job of evaluation and you know where your ROI is and who your high performers are, low performers, you want to get rid typically of the bottom 20%,
Hmm.
but structured a little bit by, okay, where do I earn high ROI or low ROI? So it's not usually a uniform 20%, but
Yeah.
more or less you'll get there. Okay, but the problem is if you now do this in more than one round of cuts, the top 20%, so founders think, yeah, the top 20% will still stay with me because they still believe in my vision, etc. No, if you do this mistake, what will actually happen is that the top 20% will actually think you're an incompetent leader
Yeah.
and will think that the organization itself has no future because it is poorly managed. So
Hmm.
whether they believe in your mission or your vision or your product at that point for the top players in your organization actually plays the lower role. What
Hmm.
plays the bigger role is that they think that you're incompetent at doing what you're doing. And so in effect, you're stuck with the middle 60% at best. And
Hmm.
that is not the purpose of actually cutting down fat because you want the muscle to retain, right?
Yeah.
But now you've actually also lost the muscle. And in the end, you might only be skinny bone.
Yeah. I think one other thing to call out here, especially in the context of the possibility of the top 20% leaving. I mean, in previous episodes, we've talked about how AECS is a very track record driven sort of industry, and also influenced by relationships, who drives the outcomes, etc. The longer you keep doing cuts and leaving people in a limbo, you're just going to create a very adverse dynamic where you're probably creating an incentive for the top performers to think about either starting off their own companies or branching off in other paths, taking your clients with them, in a way where, because they may know things better by now, and you're not giving them any incentive to create value for you. You may enable them to leave and become your competitor.
Yeah. Um, So we said going in at the top of this episode, hey, focus on the things that you control, right? And so in this event of uncertainty, you're entirely in control how to play this. Now, you weren't necessarily entirely in control what led you here, but once this event happens, you're entirely in control. And every mistake from here on out in executing or dealing with this type of event, that's going to be on you. There is no
Yes.
externality. And it starts with one thing that you control that I want to point out is do not overhire. Just
Mhm.
go slow. Whenever you think you're going slow on hiring, most likely you could go even slower. Now, of course, it's always a multivariate problem. There's different things to consider. And that's why I also can't give you the one size fits all type of answer, like what is a good rate of hiring.
Mhm.
But in general, I have seen founders, especially first time founders, hire too quickly across the board. And so
Mhm.
that's when then actually you have, in these kinds of situations, already lost control to a degree.
Mhm.
Because now the numbers might play against you. The dynamics of the team in large groups might play against you, right? So the best way to stay in control is to never be oversized,
Mhm.
right? So another event of uncertainty that can happen to you is so here we're talking about large volumes of employees.
Mhm.
What if you have a small number of customers and a customer concentration risk, and that customer represents a high share of your revenue, and then they bail on you? What is that event like?
Yeah, I think so. Just to paint a picture of the kind of situation we're describing, look, if you're a very young company with, say, 5 clients, each of these clients is, say, between 15 to 30%. I personally am not, I wouldn't find that alarming. I would say it's natural evolution of the company. So that's not the situation we are describing. To give you an example, and I don't want to name the country or the project involved here because we are fans of what's happening there, but it's just a characteristic of some of the companies we see in that part of the world. But so there's a country where you find that quite a few of promising startups emerging from that place, they have like 80% of their revenue or their pipeline exposed to a certain project or a certain set of clients attached to a project. And I must admit, I often end up asking, hey, so what's the backup plan if this project is maybe not shelved per se because it's too visible, but it's just throttled for a year or two, right?
Delayed,
Delayed,
throttled.
exactly, right? Some funding was supposed to come in, it's stuck somewhere, right? Or the scope of the project is reduced, which is
Oh
what,
yeah.
right? Which is maybe then makes some of these solutions redundant, etc. And I must admit, it's very, very rare I get a satisfactory answer. And
Okay. What
that's
kind of
why.
answer? What are the answers?
So the answers are more of a deflecting nature, wherein they say, no, no, everything's good. This project's very robust, etc. What the revenue that we provide or we aim to extract is a very small proportion of the overall project, right? Etc. Etc. These are large companies. We are working with a global leader who's working on this project, so that way it's also quite a secure, it's not a small company we are associated with, etc., etc., which I guess are all academically sound reasons, but they still don't solve the heart or answer to the heart of the question, which is what will you do if the situation turns adversely, which, if you're intellectually honest to yourself, if 80% of your revenue is attached to one project or one set of outcomes working in your favor, you cannot, in good conscience, define that as being a robust setup in terms of risk adjusted probabilities.
Not really. And also in terms of it doesn't even have to go haywire on you. Just if even if it doesn't go haywire, you have just built a customer portfolio where you have no leverage in
Mhm.
your bargaining negotiations. I
Yeah.
mean that's an even you don't even have to paint the adverse scenario to already see negative benefits from that. Now,
Yeah.
when the adverse scenario happens, um, Shub, how does it feel? Like what happens to the founder? Let's say I have 50, 80% share with one customer of mine. What happens?
So look, the issue is, so before I answer that question, let's talk about the symptoms of what happens to the founder and the company in the path to getting one client
Okay.
representing that. So what will usually happen is, in terms of that, obviously the time and energy you have given this project will be disproportionately more than everything else, wherein you have perhaps, as an opportunity cost, you have not devoted enough time with the other clients, right? And they're also used to seeing you as only representing that slice of time or energy or resources. You've also, because you've committed such a large share of revenue to this one client, to this one project, you've probably tailored significant parts of your product and your value proposition and the way you brand yourself, the way you market yourself to that
Right.
project or proposition, which, I mean, perhaps, it has universal appeal and perhaps it appeals to the others, but perhaps it may not, or perhaps it will need some rework if you have to serve a different set of clients or a more well diversified set of clients. And these are all things which is not, you cannot just snap out of it one day and decide now, now I'll be sorted and I'll be equally good, because for all you know, even the pricing may need a redo, because quite often there might have been a very good reason why you decided to make this one client or this one project 50 or 80% of your revenue, maybe because the pricing was very good. But then
Hmm.
are you okay, if for whatever reason this client or this project goes away, are you prepared to deal with clients who don't offer you only much lower prices? What happens then to the overall viability of your company? Are you prepared to redo the whole thing for a very different kind of clientele? I think these are questions which I find founders who have found themselves in this situation don't pause enough to think of it. I've often found.
And then when it happens, when this client then walks away from you, what I can tell you by experience is it will not feel to you like a discussion.
Yes.
It will not feel to you like, you know, we're thinking about doing this
Hmm.
perhaps in 2 years. Let's prepare for it. Perhaps there's something else you can build out so that it doesn't happen. That is not what will be like. What it
Hmm.
will be like is an email followed by a quick phone call where that customer informs you that they're walking into a different direction. That is what will happen 9 out of 10 times. And
Yes.
so for you, that means you absolutely have no way of mitigating that because the event will have happened to you before you become aware,
Yes.
right? Which means you have no way of influencing or averting that outcome other than doing all the things that you just walked us through in anticipation or in leading up to this event. But then once the decision is made, you will be the last to hear it, not the first,
Yeah.
right? And it won't be, you won't be involved in the decision making process leading up to it, right? So normally that is the case, right? So now at that point, you're going to scramble.
Yeah.
You will first think about, oh, but perhaps we can do something. Can we meet over this? What can I do to rectify the situation? Do you want me to offer better prices? I'll throw this in the mix, etc. All of that is futile. Forget it.
Hmm.
In most of the cases, that will be futile. So you will be left with, oh, maybe I didn't spend time with other customers. Maybe I actually didn't develop my distribution channels as quickly as I should. Um, to your point, maybe my product is actually not is so overfitted to
Hmm.
this one, not necessarily even customer, but this customer type, and that customer type maybe isn't as repeatable as I wanted it to be
Yeah.
because the basket was so big.
Hmm.
Now you will have to figure out very quickly, in most cases, how to cut cost.
Hmm.
That's oftentimes the implication. Now, when you have long runway, you can sustain it and you can say, hey, actually, I don't want to cut costs because I have great people. I'm only 20 people, right? Giving example here, right? I'm only 20 people. All of them are high performers. I still
Hmm.
have like 3 years of runway. These situations do happen. So not to
Yeah.
everyone, but they do happen. Okay. In that case, better situation. 18 months runway, 80 people with that kind of concentration risk, that would be a cost cutting situation
Yeah.
immediately if you're a good manager.
Yeah. And we haven't even talked about a much more harmless kind of scenario where once the client on the other side knows that they are 80% of your revenue,
Yeah.
of course they have the bargaining power somewhere down the line to just turn around and say, hey, now we want the price to be halved, or something like that.
Yeah. Yeah. I have so on that point actually, this is not a theoretical situation. In the construction materials industry, for example, I hear from incumbents all the time. All of them are the same. that, hey, they don't say it this way, but I'm going to say it this way. The realization oftentimes is, hey, I'm actually the behemoth, the 500-pound gorilla in almost an oligopolistic part of the market,
Mm-hmm.
right? It's building materials in the end, which is a high fixed cost business oftentimes. So you
Yeah.
have more or less an oligopolistic structure in many, many different subsegments of building materials. They know that. They would say it that way, but they know that. And so these people then tend to go to founders and say, hey, I'm going to make you. That's
Mm-hmm.
the attitude with which they come, right? I'm going to make you. So I need to get my pound of flesh, right? And
Yes.
so that's the problem when you need to rely on one or two people, customers specifically,
Mm-hmm.
um, yeah, to be your revenue base.
Yeah, that's right. Um, I mean, we haven't, a lot of people perhaps, when we are talking about adverse events, sudden shocks, they're probably even thinking of what happened early in the at the onset of the pandemic, and I guess that's the pandemic or pandemic-like events. I mean, in the last few years, we've had obviously the pandemic come on. It also felt like every time there was a new variant of the virus identified, that was like a bit of a shock to the ecosystem. When we had the Ukraine invasion situation, that also felt like a big macro shock. I mean, it definitely did upended a lot of things about the VC financing and how things have
Yeah,
been happening for the last 2.5 years.
yeah.
Is there
I've
any
been a sorry, sure.
I mean, would you think that's also something which a founder could plan for? I mean, obviously, we won't know that a pandemic's coming ahead of time, but how can you make yourself more resilient in the face of such events?
I for myself, I found the answer, and it's actually a universal answer that always works, and that is keep your ears on the rail tracks,
Mm-hmm.
because or a better metaphor that we've been using before is have the co-pilot in your rally car and actually make sure that they give you clear directions for what's behind the next corner. So the metaphor works like this. As a startup founder, when you're in a successful business, and especially when you're venture backed, you're typically going at like 200 plus miles per hour.
Mm-hmm.
And it's not a straight line. It's not the Autobahn,
Yeah.
right? So that's where the rally metaphor comes, right? So there are corners, there are cuts, there are slopes, ups, downs, different types of terrain. And when you go at 200 miles per hour, you cannot react in the moment,
Mm-hmm.
because that already catapults you off the cliff. You actually need to make the next steering decision
Yes.
before the corner is there. That's what the co-pilot is for in rally driving. As I said it on the other episode, my father was a semi-professional rally driver. I was not, but that gave me a little bit of empathy and fascination for that sport. And there is so much analogy
Mm-hmm.
with startup driving. So keep your ears to what people in the know are telling you. And the best managers, the best founders will, when such an event happens, like COVID, February 2020, will actually proactively cut personnel,
Yeah.
simply because they know that, hey, if this ends up being a 1 month problem, sure, I've just probably fired my lower performer part of the organization, but even then, it's still sort of an opportunity to find efficiencies, to refocus, to let go of a few things that perhaps weren't as high ROI. But best case, I've just won a lot of additional lifetime for my company, and I can be much more resilient in this worst case situation. The worst founders, and unfortunately, this is more of the norm, will
Mm-hmm.
actually not act, and they will just see what happens. They want more data points before actually deciding. And that most of the times turns out to be the wrong way of managing it.
Yeah. One thing, I was about to say hack, but it's definitely not a hack. It's quite a bit of hard work that I think is like a answer which applies to each of these events or adverse situations that a founder may be faced with, is just incorporate the practice of making yourself audit ready, or even become your own auditor. just constantly maintain books, like really respect and learn to develop a liking for the practice of having very detailed books, looking into them, using them as a mirror to reflect how the firm is doing, and using it to judge yourself rather than judging it on some vanity metrics or some other things which are not at all relevant, perhaps, because I think it will remind you of what is going well in the business, what is not, where the firm is doing well, so that you don't cut the muscle if you have to do a cut, where the inefficiencies lie, and also where there may be hidden opportunities where if you have to act in an adverse situation, maybe you need to pivot or make a different move. It may give you some ideas and inspiration for that as well, and it'll definitely also help with I mean, if for example, going back to the first event of the round not coming to through, it will definitely help you raise your round and also conclude it without any drama, or with much lesser drama than usual, if you're already on top of your company's books and doing it as a regular practice.
I fully agree. It's hard to prepare for an event that has already happened at the time when it has already happened. The preparation always starts before.
Yeah,
And that's why no one sells you an insurance after the earthquake has happened. You can buy
exactly.
insurance before, but you can't buy it after for the same
Yeah.
event. So that's exactly what this is like, right? And so, Shub, we have two more events that we can perhaps quickly touch upon.
Mhm.
Um, Event type number 4, and let's put it again back into the construction tech context here. Imagine you're a construction tech founder, and your co-founder actually
Mhm.
informs you that they want to leave the company. What
Mhm.
does that feel like?
I mean, look, first thing to say here, hopefully you have done a great deal of diligence, put a great deal of thought in picking your co-founder, or in being picked by your co-founder, because that is the most important step in trying to reduce the probability of this adverse event happening in the first place. And I think no amount of work done post start will help remedy any work you hadn't done before coming together. So I think that needs to be stressed right up front. Again, if you are the reason the other co-founder has decided to move on, then again, you please fix yourself before trying to come up with band-aids to a gunshot wound, as the proverbial saying is. Now, assuming that you are in the right and for some other reason your co-founder has moved on. Okay, this is a tough one. I think I would imagine it also depends a little bit on what sort of resources are available to you. So if you are a company who has raised money before, has a bit of a team, what at least I like to always suggest the founders that I work with is not to, in the early days, not to think of it like, hey, we are the founders, everyone else is like a junior resource, and off we go, right? It's always to think of the first few hires you make ideally should be the next level of leadership. Of course, that doesn't mean that they are the doers and you're the managers. In the early days, everyone is a doer, and no one is quite has earned um, the privilege of being a manager just yet, if it can be called a privilege. Um, but
Not to my ears.
so, so so hopefully, if that's the way you have built your team, you may find that if your co-founder has moved on, assuming in this case it's a two founder, or it was a two founder setup, the one founder that has moved on perhaps can be replaced in some way with two other leadership level hires, or relatively quote unquote senior people that you may have in the team. They may step in, at least in terms of competence. Now, in terms of equation, chemistry, that is a much harder gap to fill. Although one would also ask, hey, if the founder split is happening, perhaps there were problems with the chemistry which needed to have been fixed way before you started. I mean, that's, I think, again, assuming you're not the problem, assuming you've already done the homework before coming together, that's what I would suggest as a way to remedy this event, to have maybe a couple of people step in as quasi co-founders, or in a support capacity.
Right. And in terms of how this can feel like, so I'm right now, I have to think of a marketplace startup in construction to whom this happened recently.
Mm-hmm.
And the founders actually had previously built a company with
Mm-hmm.
each other. So, I mean, as much as you can vet each other, etc. And yet it came to the situation, I want to say like 2 years in, where one of the founders said, "Hey, actually, I realize this is not my passion project. It's not something that I feel passionate for." Um, and it was a founding team of three, and the other two co-founders. I'm not sure they tried to convince the third founder to stay. It didn't seem to me like that. Also, perhaps because they knew each other very well and they had spent a lot of time with each other. Um, but what it also feels like to them in that situation was, okay, um, I don't try to convince you, I don't try to win you over because it's futile, and
Mm-hmm.
even if I do, it's perhaps more a result of guilt tripping than actually you wanting to be here. But rather what it feels like is, hey, let's make sure that we actually um, go into business continuity mode, right? So if that co-founder was responsible for customer development, for example, or
Mm-hmm.
supplier development, or was responsible for the technical side, there are relationships involved that need to be transitioned in order to ensure business continuity. So what it will feel like is like drinking from a fire hose
Yes.
for the remaining co-founders. And so the first thing you would do is actually understand, hey, what are the relationships here? What do they think of us? Are they more interested in the brand and the product, or are they more interested in the person?
Mm-hmm.
If it's the latter, you need to come up with a very, very strong transition plan, ideally with a parting co-founder, not in a matter of days or weeks, but rather in a matter of months.
Mm-hmm.
That's what you would want to do if that's what it is. If it's more related from the customer or supplier side to, hey, there's actually an established brand, there's an established product, the channels are repeatable, then you can probably get the second in command that worked with that founder to step in. Again, the longer the transition you can foster, the better. That is obvious.
Mm-hmm.
Now, when it's an engineering leader, the engineering organization, that can be extremely fickle. So that's where, especially in companies that rely on relatively strong software portion of their business, that can truly break companies. And there, that might be the most difficult to actually mitigate and to foster transition around, because engineers have a lot of optionality in their career, and they tend to value how they work as much as what they work on. And
Mm-hmm.
so that introduces risk when the person that they are used to, in terms of how they work with each other, transitions out. These people, because they have optionality and because they value that, they might not want to deal with that kind of risk. So unfortunately, the only way there, how you can do it, ideally, is to promote from within.
Mm-hmm.
And if you then don't have a strong uh, like internal talent, that is hard. I don't know what advice to give there, but if you do, that can actually be a really good transition, and it should ideally be endorsed and co-fostered with that parting engineering type
Yeah.
of co-founder. Yeah.
Mm-hmm.
So it will not feel, to most founders that I know, it will not feel like betrayal, or it will not feel like adversity. These situations do happen, but I've seen more of a mutually friendly parting of ways.
Mm-hmm.
And then what it will feel like is just drinking from a fire hose and having to very quickly gain control over the risky relationships.
Yes.
Yeah.
Agreed.
Shub, final type of event that perhaps and hopefully only very few people will ever experience in their founding career. I have not seen this a lot in construction tech.
Mm-hmm.
Fortunately, I think we have been seeing this in our past careers, in other sectors more than we have it in our sector.
Mm-hmm.
Nevertheless, lawsuits. What if a
Mm-hmm.
lawsuit happens to my company from a customer, a supplier, a former employee, or a competitor, actually? What does that feel like?
So, the interesting thing, just to point out, the this doesn't mean one is better than the other, just to be clear to our viewers and listeners. The probability that you may be, as a business, at risk of facing a lawsuit increases dramatically if you become a consumer facing company, or a
Hmm.
B2C or a D2C type company. Again, this is not to say either of those are bad opportunities, but just because as we say, consumer is king or has power, etc. And obviously when you split up your demand side to a unit of one retail customer, you increase the set of probabilities. You
Hmm.
increase the probability of edge cases manifold, because each customer is an edge case basically, right?
Agreed.
Which is why some of them, when they are particularly unhappy, they may come after you for consumer protection, etc. This is not to say any of this has to be taken trivially. I'm just saying it just is a different kind of thing. And the reason I'm mentioning this is in one of our companies, we have come close to like an individual customer filing like a complaint in a sort of consumer court capacity, etc., trying to seek some sort of remedy. And again, in that case, it was actually quite easily fixed, etc., by just this problem being solved by the company in question. Now, I presume the question you had in mind was of a more serious nature, not just a single individual customer pissed with the order delivery, but something of a more material nature, something which, say a larger business client who's come after you, or there's some observation of a malpractice, perhaps, something not happening per the code or the law, etc. Yeah, these things are quite rare, I have to say. In our episode, I think, which one was that? Maybe number 18 or 19. We went through where I think the episode was about all the, very bad behaviors and
Mm.
a very extreme set of examples that we've seen in construction tech companies and the truly bizarre things we've uncovered. I think one of those cases was about the founder having lawsuits in a personal capacity,
Hmm.
right? Um, Again, look, stating the obvious, if you as a founder are in a situation where you're being facing lawsuits, you first got to fix that situation, right? If you are the problem, you got to solve the yourself first before trying to look at other, hacky solutions to fix it. Yeah.
So I can think of two incidents within our space, and that really is not many, which is a good thing. One
Mhm.
of them was an example that you had made me aware of, where a board member in a
Mhm.
company was actually being accused
Yeah.
of what's the term? Help me out,
Bribery,
Shub.
bribery.
Bribery.
Yeah.
Thank you. And
Yeah.
the other one was where actually two construction tech startups sue each other. One
Mhm.
was a supplier to the other, sue each other over bad quality inventory. So
Mhm.
I can speak to the latter. I mean, that is one where how it feels like is none of the two. Every side always feels like they're right.
Mhm.
Nobody goes to court uh, because they feel like they have no chances of winning. And usually you feel like you have high chances of winning because you feel you're in the right. And so it will feel to you like you're in the right. So your sense of um, justice will kick in for
Mhm.
most people, and your natural inclination will be, yeah, but why should I settle, or why should I compromise, or why should I let go, because I'm in the right and this is not this is injustice,
Yes.
right? Another part of your brain will kick in because you will probably have conversations with other people around you that you're seeking. That will be your co-founders first, then it will be perhaps certain shareholders,
Mhm.
perhaps some employees that are involved in the transaction. um, and that's when the rational part of your brain will actually tell you, yeah, but what's the ROI here, and what do I have to win, what are our costs of doing this? And your two brain halves will be at constant battle for a while. That's what it will feel like. And
Mhm.
so if you can prepare yourself for this kind of feeling, the more likely you are to actually look at this rationally.
Yes.
In the end, not every lawsuit is actually worth even fighting, both if you're the accuser or the accused,
Yeah.
the defendant. Not everyone is worth fighting. The more you can prepare yourself for such a possibility and that it's a rational decision, nothing
Mhm.
else, the quicker you will come to an optimal decision under suboptimal circumstances for your business. The less mentally prepared you are, um, of this, the longer it will take you to come to any kind of decision, let alone the optimal decision. So that's like the best advice I can truly give here is you will never be prepared fully for a specific type of legal action, but you can prepare yourself generally for the prospect of legal action and how you want to deal with those.
Yeah. And look, I mean, neither of us are legal experts or experts in every country, but I can tell you there's some countries where the probability of facing lawsuits is exponentially higher than
Yeah,
in
I know one
other.
such a country.
So, like, if you're in one of those countries with the exponentially higher cases of lawsuits, you're probably living there or you're a founder building there. So if you are indeed in that country, then hey, I mean, I think that is one event slash risk that you always have to be mentally prepared for.
Yeah.
And I think in that situation, again, obviously the details of the lawsuit or the accusation matter, but as Patrick, you mentioned, not all battles are worth fighting for, because especially in that country, things can get out of hand and extremely expensive very rapidly. So it might be in your interest to pick your battles smartly
Yeah.
and control your downside.
And most investors that I know, for sure, early stage, and even I would say a majority later stage, will actually advise founders not to go to court, because it can have a ton of adverse effects on, for example, fundraising plans. A startup with a lawsuit during a legal due diligence will always have a lot of explaining to do to new prospective investors, and that's something that early stage investors absolutely hate as a risk.
Yeah.
Bonus question, Shub. Final 1 or 2 minutes here. What if a competitor does a smear campaign against you?
By the way, very nice bonus question. And I think if someone is looking at this and saying, "Hey, are we like talking soap opera stuff?" No, the truth is we have actually seen this happen in real life.
It's in construction tech, in marketplaces.
In construction tech, uh, between two very high quality companies. So it is a legit question to ask. Look, frankly, I think firstly, it is very hard to prepare for that, especially in the event that your competitor also has smart people, is well equipped, has good, strong resources. So usually they're all playing 6D chess rather than 2D chess, right? So which is why everyone can think ahead. Therefore, I think, frankly, the best line of defense is to follow all the other things we have said on this episode. That is, you run a tight ship, you keep your audits, you so that if an accusation is made, you present your books, right, to prove where you actually stand.
Great.
You Again, I don't want to take names right now, but there are also companies who get way ahead of themselves in making claims about where they will be a year from now or 5 years from now. Sometimes it's good to actually, instead of making claims, say that, hey, we have done this, and then claim congratulations for that.
Yes.
Right? So in other words, first do the thing that you think you'll do, and then feel good about it, rather than trying to act like a hero by claiming you'll do all these great things. So sometimes also staying within your lane, and staying humble, earning your all the applause or the laurels that you think you'll get, earning it first. That's also quite often a smart way to do it. Um, yeah, I don't know if you have any smart advice for this situation.
So this never happened to me in neither my capacity as a founder myself, as a manager, or as an investor. But I've been looking at it in the example that you have been giving from afar. And within the markets I cover, within the renovation space, solar renovation specifically, I have seen that play out in the last year too, on social, for example. Neither of the two were companies that I was involved in at all. I also had no relation with the founders, but it was very, very public. And my conclusion from that was that there's two extreme ends of action that I would consider the next time if this would happen to me. The first one is it can actually be an immense PR opportunity if you engage in the smear campaign. Now, the tactic of engaging, I would recommend anyone, if it's truly a public, high risk or high stakes smear campaign, engage a professional risk PR agency. Do not try to figure this out, because what it will feel like is it happens in real time. When this thing happens to you, it's not like, oh, in 6 weeks there's the next event and I have time to prepare. No. When this happens, it literally happens in real time. And so
Yeah.
the best people are the ones that have gone through exactly that type of real-time PR risk process before, and that's who you should hire. It will cost you money, but it will actually save you money. So that's the one end of or the one extreme end of how you can deal with it, and the other one is not to engage at all. If you think there's no opportunity, no PR opportunity for you in it, then not to engage in it at all. However, not engaging in it at all publicly doesn't mean that you have let your core relationships, customers, suppliers, financiers, employees know what is going on, and then
Yes.
produce the facts
Yeah.
that you have been saying. Now, when at that point you still have to produce the facts, then all of a sudden you're in a 6 weeks time frame, and that's bad. So be
Yeah.
ready for it.
Yeah, I think that I think the second part of what you said, I think, is immensely important, and I've seen the importance of that play out in real life. I think the worst thing you can do when faced with a smear campaign is go quiet to the internal stakeholders and not be able to adequately answer to their questions. So again, have the auditor mindset, be prepared to be grilled and come out on top. I think that's the attitude you should go in with.
Great
I mean,
advice.
if there's any silver lining to this last bonus event we spoke of, if someone's coming after you with a smear campaign, hopefully you have done something to deserve it, right? Which is why you should continue to be on guard. But again, don't become complacent just because you've got to a certain stature. It also means a new set of challenges and events become possible given your heightened stature now.
You're right. No one fights me if I'm irrelevant.
Exactly.
Speaking of relevance and auditor meetings, what's in your calendar next week that excites you?
So there's an interesting new opportunity that has my interest peaked. But by the way, I have to point out, um, before I was a VC, I didn't use the word interesting anywhere close to as many times I do now. I feel like all VCs just use the word interesting. They abuse it to death, I feel like.
Oh, really?
Yeah, it's just used way too often.
Interesting.
Yeah, exactly. Exactly. So so what I'm looking at now is the space of fenestrations, that is doors and windows. I find it super fascinating as an area for new kinds of manufacturing like that brands, supply chains solving specifically that opportunity. There's again some hidden champion brands there. And I think there's an opportunity for new age companies to come in and enter that space with some innovations. So looking
Okay.
into that quite closely.
Sounds like a very
Yeah.
interesting vertical.
What
In my
about you?
books, yeah, I'm currently working behind the scenes quietly on a thesis that I think is extremely complex to pull off,
Hmm.
but has true moonshot potential. And I'm getting all the right market feedback. The problem is I'm not seeing a team. So next week, I'm meeting a founder that came highly recommended
Hmm.
from my founder network and meeting that person to discuss specifically this very difficult moonshot opportunity.
Hmm.
But looking forward to that meeting.
Nice.
Yeah.
Sounds exciting.
Shub, this was way longer than I actually thought we could speak about, like
Yeah, exactly.
events that can happen to you as a construction tech founder. But I have to say, I thought this was very, like, also even
Mhm.
self-refreshing how to deal with these situations.
Indeed. Indeed.
Great. Well, that leaves me to wish you a wonderful weekend then.
I wish you a wonderful weekend as well, sir.
All right, man. Cheers.
Cheers.